All right, so in traditional financial markets, we tend to try and solve the problem of banking crises and the issues created by fractional reserve banking through having heavy regulation and a central bank backstop. But in crypto, what we're going to see is that banking regulation it's likely to come for sure, but I think it is difficult and often undesirable. So let me explain. Because crypto assets are global and decentralized, you can send capital very easily anywhere in the world because it's not actually tied to a specific jurisdiction. So crypto exchanges can very easily migrate to weak regulatory jurisdictions and set up shop there. And therefore, people who might even be physically situated in a strong regulatory jurisdiction, they can still very easily send their Bitcoin or Ether to that exchange, thereby effectively circumventing the strong regulation that you might see in the strong regulatory regime. And in fact, this is exactly what we saw with FTX. FTX was regulated in the Bahamas. I mean, it's not like the US has perfect oversight on its crypto exchanges, but I think much better oversight on its crypto exchanges than we see in the Bahamas. And this problem is going to exist going forward. And in fact, if the US regulators get too tight on crypto exchanges, this can even exacerbate the problem. So once again, it's not to make the point that crypto regulation is not going to be coming and more down the path, but we need to be very careful about not just pushing all of the exchanges towards weak regulatory regimes. And even in the instance where we see regulation, we need to be cautious about what that regulation looks like, because regulation empowers the politicians and policymakers who govern it. It creates barriers to entry, which can create oligopolies and powerful institutions which have strong relationships with those regulators. Once again, that's exactly what we saw with FTX. FTX and Sam Bankman-Fried had a very strong relationship with the SEC and with US politicians. So that type of centralization in the hands of certain exchanges and certain politicians and policymakers is not necessarily what we want to see in crypto. It's also important to note that regulation doesn't necessarily advantage consumers in the way that we hope that it will. And it also doesn't necessarily solve fraud. We've seen tons of cases of fraud in the United States, despite the fact that there's heavy regulation in this jurisdiction. Simple examples of Enron and Barings Bank, and even Theranos with Elizabeth Holmes in recent years. So as I've pointed out, this doesn't mean that centralized crypto intermediaries are not going to get regulated. In fact, many of them actually all are already regulated. The question is, are regulators going to impose the existing regulations that we have on those institutions? Are they going to check their books and make sure they're not committing fraud? I think that would be quite a helpful thing to do. Now, central banking clearly goes some way to prevent bank runs in traditional financial markets, because you've got a institution standing as a backstop that's saying that if the bank runs out of money, the central bank will just print it up and give it to them. So I can appreciate that it has a positive impact in that regard. But let me explain why a central bank is impossible in crypto markets and also potentially undesirable. So because Bitcoin and Ethereum are decentralized monetary technologies, there's no institution that can print up those assets and give them out to some failing institution to ensure kind of solvency of the system. So technically, it is impossible to actually have a central bank in the same way that we have in traditional financial markets. But even if you could have one, it's also quite clear that this is not what we would want in crypto markets. Regular viewers of this channel will understand that it's a big passion of mine to understand the consequences of central banking, which I think are numerous and challenging for the world to deal with in the 2020s. I'm not going to go into all of those examples here, but the FTX debacle provides a very clear example of one of them. So, FTX itself was almost trying to act like a central bank in May and June this year. They were bailing out BlockFi and Voyager and a few other centralized platforms. And this was hailed at the time as though, FTX was saving the market. But they weren't saving the market. They were masking the underlying challenges both in those institutions and their own institution, which has led to another crisis further down the road. It would have been far better for the market if we just let the problems fail in the first place. Sure, it might have had a bigger negative impact on price at the time, but the problem would be in the past rather than us dealing with it again in the future. And that's in fact the age-old problem with central banking, that it always tries to mask over the problems in the short term, leading to bigger problems down the road. And we've seen the same thing again in November, that Binance was threatening to bail out FTX. Well, hopefully it's clear now that that's actually a good thing that they didn't go through with that bailout. We don't want to mask over FTX's fraud and bad business practices. We want to uncover these, root them out, and push them out of business so that we can move on and have a more stable, sound financial system going forward. All right, Rob, so that's not a particularly positive outlook. You said that the solutions in traditional financial markets of regulation and central banking aren't necessarily going to work particularly well in crypto. So what do we do about this challenge? Well, here are my 5 key conclusions to the whole FTX debacle.